Hey, it's Mike again, doing another one of these super long videos that is very helpful if you have a hard time sleeping at night. Just put it on. It'll do the trick, trust me. But today, what I want to do was kind of pick up where we left off on the last episode, where walk through how to build model books, and we talked about how to make money in stocks and all the model books, stocks that are in the front. And I wanted to go over one of my favorites, and this is Cisco. The bill marked up in here, and I would suggest studying this one because there's few stocks out there that are as important as Cisco as far as the move that it made. And I just want to share, let me see, I'm going to, and bear with me, I'm just doing this video, on the weekends without any video crew to help me. So just be patient. My video skills suck. So let's see, I'm going to share my screen. Okay, let's hopefully you're going to see the Cisco comparison chart from Market Surge. So this is starting off when it went public in 1990, going up to the March of 2000 top. And up in the top left-hand corner, you can see this huge number, looks like 95,000% for Cisco versus 350 for the S&P. So that gives you a motivation to want to study this one. And I'm going to bring over this marked up chart that Bill did with a lot of Justin's help. And we put these out, or he put these out in the paper, and you can find them, online, various places people have scanned them in, or they might be on our website somewhere. But this is how Bill marked it up. Now, he marked it up differently than he did in the book. So one thing I wanted to focus on, well, I wanted to focus on all of this, but we're going to do it kind of Webby's way instead of Bill's way for today, because I'm not Bill. So when you compare it, you should compare it to this, also marked up by Bill. And on this one, you'll see that he continued on not saying to sell it here. On this one, you just have buy, add, buy, and then one sell on there. And selling because you have the stock split and it's breaking out, and he says it's going straight up from the bottom there. And that's his way, or was his way, of studying these things, as far as just marking on there with hindsight, with perfect hindsight, of where would you have wanted to buy them and then ultimately sell them. And in the book, he doesn't say selling here. He actually has a buy, out a little bit from there. And I'm sure if he, did it again, he would, put the sells at different places. So that's not my style of doing it. And I just want to walk you through my style. And it's not that saying his style is wrong. His style worked perfectly for him, but it didn't work for me, because I would rather go through and ask myself, okay, in the real world, if I'm buying it down here, am I really selling it up here? I'm not. I know myself. I've been trading since I've bought my first stock as an adult in 1995, and got really serious in 97 forward. And I just know that that's not in the cards for me. And frankly, I traded with Bill for a long time, and that's not how he traded either. But this is how he marked them up to learn. And it's just like a golfer going to sorry, I'm just going to stop share for a second. It's like a golfer going to a driving range. If you're Tiger Woods, which would equate to Bill, he's not just playing 18 holes every time. He's going to the driving range, and he's, trying to do different shots. If you're, a basketball player or a football player, you're studying films, boxers as well. So this is what the model work is the studying part, and it should be very fun. And when you do this, and do it on the weekends or after the market's closed, and try to make it fun. And if it's not fun, stop doing it. and wait until you're in the mood to do it, because it is very important to be in the right mindset to learn and not just feel like it's busy work, because this is the most important thing that you'll end up doing. So now what we're going to do is, let me share that one more time. We are going to focus in at the beginning over here. Now we're going to go a lot of bar by bar through here. So obviously, we're not going to go all the way out to 2000 bar by bar, but we're going to just kind of focus on getting started right. And this one was so important to me, frankly, studying this down here, that back in when I was in Bill's research department back in the 97 to 99 timeframe, I had printed that chart off right where it was down there, and I kept it next to in my little cubicle for years, just always having it in my view, because I told myself if the next Cisco comes along, I didn't want to miss it and I didn't want to mishandle it, and I just wanted to get it etched in my memory. And I haven't really looked at this, and I mean, besides workshops, I used to teach workshops with Bill, and also taught him, with Charles Harris. We did the IBD market school and chart school series together, and I did some advanced workshops with Bill, and so Cisco would always come up, but I haven't looked at it since. Really, I got heavily into it back in the 90s, and so it's time to dust this one off. And I hope you guys are going to enjoy this. I'm going to be learning as well, because I learn every time I do this, I learn something new. So let's start this puppy off, and let's share one more time. Am I already sharing? No, I'm not sharing. Okay, we're going to get rid of that. Going to get rid of that. We're going to bring over what Cisco looked like at the very beginning. So it goes public, has this little IPO base. It's a little shorter than normal, but could have been bought. We're not going to study that today. That'll be for another video. And I was the one who invented the IPO base, and there's a story behind that. And I'll save that for another day. But you have a prior uptrend, this nice little cup with handle. And as you're looking at this, and we did a change date of market surge back to May 24th of 1990, and you want to really put in your mind that this is just another chart, that this is one that you don't know that it's Cisco that goes up 95,000% or whatever it was. Because then that'll skew everything. You have to be intellectually honest. Is very, very important. If you can't be intellectually honest, then just stop. Absolutely, this is a waste of time. Just go, I don't know, go swimming or go for a walk or something. Go to the gym, do something else, because if you don't have intellectual honesty, this is going to hurt you more than it's going to help you, frankly. So you're asking yourself, what would you do at this point? You've got this cup with handle. There's really no buy point. You've got a declining tops line here. That's how I would draw it. Some people might draw it from the top there. I think that's a little too steep. So we're going to refresh that, and I would do it right around there. And you're waiting for it to break or to have an upside reversal. There's no upside reversal yet. So there's nothing to buy, and that's being intellectually honest, just looking at it, unless you were just nibbling early for no reason. There's no buy point here. So we're going to go out one day. Okay, so it comes down, but still, the closing range on that day is 33%. You can see that in the track price. So what that's telling you is it's in the lower half. If it was at 50 or higher, it'd be in the upper half. So there's really no reason to buy it yet. So we'll go out another day. Still nothing going on there. Nothing, no reason to buy it. Okay, boom. Here's our first buy. Is breaking that declining tops line. You got this big day. You can see up in the top right-hand corner, it's up 5% on the day. And you have to assume with this exercise that you know the fundamentals and you believe that this is an A quality stock from the fundamental standpoint. And even though anyone who knows me at all knows that I do not use volume anymore, because I believe really since the early 2000s, volume data became dirty, and it got dirtier and dirtier and dirtier each year, and continues to almost on a on a monthly basis. And that's a topic for, I don't know, a lot of sleep, because it would take me 3 4 hours just to scratch the surface on that one. So probably won't do that. But anyways, I will be referring to volume in this video, because this was during the time when volume was clean, and it was a really big part of what how I looked at things, and obviously how Bill looked at things. And why I point that out is this volume was higher than the prior day, and it was higher than anything. Came in at 350,000, and that was your highest real volume, because your first couple of days of trading with an IPO, those volumes they're so skewed. Another topic for a different day. Just don't use it. You just use really on the third day after. So highs is breaking this downtrend on the highest volume, top closing range. So you're buying it. I'm buying it. But you don't know if it's going to work out. So let's go out a day. Now at this point, what you're doing is asking yourself, how would you trade this? Some people are a one and done. You just buy it once, kind of leave it there, and just put a stop in. At this point, I'd probably put if that's how you trade it, I'd put a stop at the low of that day, and just leave it alone. Or, I would be pyramiding into this. So if I bought, let's say a 7.5% position on this day, I'd probably make that a 10% on this day, because it's matching my expectations that it continued higher. And that's the whole concept of pyramiding, is that, you're putting good money after good money. You're never, you're not averaging down, you're pyramiding into it. So let's go out another day. All right, now I'm hammering it even harder, because it's following on, and now it's finally going through your standard pivot, or it's right up there. It didn't actually pass it, but I'd be adding to this. And then what you're doing is asking yourself, how much would you add? And in the last video, I talked about having a maximum position size that you're going to get. And for this exercise, we're going to just say your maximum position size is 25% of your account. And that's going to be way too high for most people. But frankly, for Bill, that would be on the low side, because he would end up, going 200% long an individual stock. Not often, but he did it many times over his career. So you have to have some sort of, and I would not suggest anyone do that. Trust me. Been there, done that, and it's very stressful. So I think 25% is the upper limit for anyone, really. I'm talking to myself too, because sometimes I break that. Well, I break it often. All right, so we're going to go out one more day. Now it finally gets that breakout that you've been waiting for. And, we've got good volume all week, closing near the, near the highs, 83% closing range on your standard breakout. So if you're using a standard breakout, a technique that I came up with was, I refer to things in day one, is your breakout day. So it's debatable whether this day is day one or the day before is day one. Really, it's a gray area, because this one just got up to your pivot area, the 25.75, and didn't surpass it. Typically, we say, 10 cents past that. Back in the day, Bill would say an eighth, before we switched over to, the whole decimalization thing, which is another reason why volume is dirty. So, what I would say is, let's just call this day, the day before this, so we're going to go back one, as day one. And that means the day before it is day zero. So my rule would be maximum loss 7%, but within that, a close below the low of day one, which is right here, that you sell a third of your position, and a close below day zero, the day before, you're going to sell another third, and then you sell the balance if you're down 7%. It kind of overrides everything. So now let's go out. Again, if we call this day one, then this would be day zero. And it does make a difference, but without using hindsight, it's tricky on this one. So an inside day after the breakout is exactly what you want to see. The reason why you're doing this exercise is to know what normal and natural is. And if you watch me on IBD Live in the mornings, we've got this show that I'm on almost all Monday, Wednesdays, and Fridays. It's a fun show. We have three, we always have four of us on there. We have a different special guest every Friday. That's always fun. We had Joe Fahmy, a good friend of mine, on this past Friday. That was a ton of fun. Lots of great guests that we get. But anyways, you'll always hear me talking about what's normal and natural. And the way you tell what is normal and natural is by looking at a ton of these examples. So an inside day, especially an inside day closing in the upper part of the range, 67% closing range on light volume, the lightest volume, I mean, you cannot ask for more. So far, so good. I'm not adding to it at that point because I like to add on up days or upside reversals. Let's see how that played out. Now it's coming in a little bit. Okay, a little bit of an abnormal action. So if we had called this day one, June 5th, then we would be selling a third of our position on this day. But if we called, as we did in this exercise, called this day one, we're not selling any because of that rule. Now, 50% of breakouts will come into their pivot area. Bill would say 40 to 60%. I did an exhaustive study, automated study of all bases from 1963 to 2013, and was able to validate what he had said with a 40 to 60. And it was right around 50% of them would pull back into the pivot area. So this is 3% down from your pivot, which you can see up in the top right-hand corner. So it's still, you might sell a little bit even if you weren't using this is day one, just because you're 3% under the pivot and you're just backing away from some of those pyramids. That's what I would be doing, because you can always buy them back. Now, the next day, intraday, you have a shakeout, but you have an upside reversal. So closing back up in the upper half. So you don't have to, if you're waiting till the end of the day for your trades, unless it's a material break, you could be waiting to do anything here. Really no reason to be buying it, adding to it, because you've just reduced it and it's still, even though it's an upside reversal, it's out of position upside reversal because it's underneath the pivot, and so there's really no need to add, but you can add if you want. Again, this is for you. You're doing it your way. Don't do it my way. I'm just walking you through how I would do it. But take your own notes. Take a little notepad, little pen, and jot notes down. Let's go forward. All right, now I'd be adding back whatever I had sold on this day, and if I sold any intraday on here, which I probably would, just being just knowing myself at the lows of that day, I would be trimming more. I'd be buying that back plus some. So let's just say, for example, at this point I had 100 shares and I sold it down to 50 shares over here, or you can say 50,000, whatever your type of money you're working with. If I originally had 100 shares, then I'm going to want to make that 105 shares or 110 shares as it's going back up, and it's this powerful. You got a big pickup in volume on there, and up 9.5%. You're buying that back plus some. And let's see how this plays out. I'm just going to start skipping to the end of each week now, which you can do with this little calendar. Okay, so end of the week, it's acting normal and natural. Go out another week, normal and natural, pulled back in. Another upside reversal at your 21 day. That's picture perfect. Go out another week. That's a little odd. This day here, intraday, and when you see a big shakeout like that, you want to think, how would you be feeling at the lows of that day? So now you bought some, you added to it, shaken out of some, added to it. Now intraday it's down at $25. What are you thinking when it's, and we'll go back one day. What are you thinking to yourself down here? Now, if you have rules that you only operate at the end of the day, which are good rules, hard to live by, but on balance, those are really good rules. But intraday, when you're down here at 25, that looks like a breakout failure. You don't know that it's going to close all the way back up there. So I'm going to be selling some, I'm going to be selling a lot, frankly, because it already tested the pivot once. Now it's doing it again. That's a little funky. So we'll go forward a day. So I was able to recover nicely. That's really good. And you did have a lot of volume the prior day, and so that's mixed because it got support on there. So let's go out a week. Doodling around, not doing anything right, not doing anything wrong. Go out another week. Now you can see that with this downtrend there, that was where you could have been adding to it as it was breaking out. You just want to know where you would be doing something. So it's looking good. And at the same time, we're going to play a little three-dimensional chess and toggle over to the S&P 500. And that's what's going on right here. That's breaking out as well as breaking that downtrend. And now you can kind of see why it was so weak, because the entire market was weak. We'll look over it, see what the NASDAQ was doing at that time. NASDAQ was acting same way. So we go back to Cisco. Looks beautiful. Now the only thing I'm thinking to myself is, how much can I get of this? If you watched Rounders, maybe you're thinking of your 3 Stacks of High Society. It's been a while, but I think that's what was the line there. Such a great movie. Let's go out another week and see how this plays out. Pulling back in is giving, when you look at a breakout, go from here to here, this point to this point, kind of the low to the high, and you don't want it to really give up more than 50% of that move. And it's, it's an art. So you could really say from your entry point, which would be right here to there, where is the 50% retracement area? And so let's just eyeball and say the 50% is somewhere in that ballpark. You're trading underneath it, which is not what you would like with that power, that type of power that you had over here, and over here. It's giving back more than what you like, which would be why I would be trying to temper myself and not go all the way up to 25% this quickly. Well, I guess I'm glad that we did. So, and again, I haven't done this one in a long time. So let's go back to where it really broke character. And this is your other goal, is to learn where does a stock break character. And we'll go to the 23rd. That's where it broke character. On this day, on the 20th, on that Friday, a little tight action, closing mid-range, closing right at 28, looks fine. If you say you're going to sell a bunch here, you're full of it, because it's not, it's the 50% retracement is keeping you from adding to it, but there's no real signs there that there's any trouble. And so don't fool yourself into it, because you've got to be intellectually honest. And I'm going to say that over and over again, because if you want to write a rule and say, okay, because there was a 50% retracement and it was in the lower part of it, I'm going to sell my entire thing because now we know that it falls the next day. Well, then try that on all your positions, and you're never going to hold anything, So if you're fine with that, that's fine, but you're probably not going to be. So we're going to go to this next day. That is a break of character. Yes, it's pulled back to your 50-day line, which is your, shoot, did I hit record? I sure hope so. Let me just stop share and see if it says pause recording. Okay, so I must have. Okay, that's a little spooky. Let's go back. Sorry. Yeah, that's not professional, but I'm not a video dude. I'm just a random dude. All right, so at this point, you're selling. I'm selling a bunch because down 6%. Let's see what the market is doing. The three-dimensional chess game. Ooh, okay. That's what is breaking this is not the stock, it's the market. I mean, back in the day, S&P coming down 1.7 on the close after it, came, bounced off the lows. That's a bad day. Let's see what Nasdaq is doing. Wow, down 2.33%, breaking underneath this. So there's more reasons to, and you can always look at other stocks that are trading during that time, like Microsoft, breakout failure. Let's see what IBM was doing during back there. Let's see, Home Depot. Oh, these are all breaking down. So this is part of your three-dimensional chess because you want to be realistic with yourself. You can't trade in isolation. It is all the moving parts. So at this point, I'm selling a bunch just based off this chart, but based off the overall market, I might be out of it, completely because, I've started buying down here, but I've pyramided in and bought some back here, added to it over here. I'm probably, up to my eyeballs in stock. So I'm going to, back away. I can always buy it back. And you're always thinking to yourself, like, okay, if this is happening, how does it resolve itself? It would have to go right back up to almost 28 or past 28, which would be over here the next day for it to look normal and natural. Let's see if that happens. I don't remember. It didn't. Okay. Yeah, I think we saw that. Let's go ahead. So if you weren't selling anything you didn't sell the day before because it was right at the 50-day, you're blown out on this day. I mean, come on. You've round tripped everything. There's no reason to be holding that. Let's go out a week. Still not acting right. Bounce back up underneath the 50. We'll go out another week. No reason to hold it. Go out another week. But you watch the CEO, he sounds great. That, the internet revolution is going on. Just think of it in terms of today, like with AI that's going on. Cisco was, ended up being the darling of the internet stocks back then. And imagine you just kind of have that in your mind fundamentally, but the chart has to mesh up with it. And that it goes up 95,000%. No, you don't know that because we're being intellectually honest. So we're going to go out another week, just going straight down. But what I always do is I keep my, so I would have, we would have been long gone, really selling it over here on this day, on that day, and anything else, everyone else has got to be out of it there. But you're keeping it on a watch list. So what I do with my watch list, my main watch list, and I do share my watch list to anybody who watches IBD Live. Look, I'm not trying to promote IBD Live. I just love the show. I don't get paid a dime for it. It's just part of my job. If all you subscribe to it, it doesn't move the needle for me either way, other than my happiness, because I like helping people. That's why I'm doing this on my Saturday. But anyways, I create a watch list every day, 2 watch lists, my full list, as well as a ready list with the stocks that are ready to be bought. And I share that with everyone. I give you all my cards. I, trying to help. And I spend hours every day working on that list, and I share it with anybody who is a subscriber there. But the reason why I bring that up is with those lists, every day I take whatever my watch list was and I put it into an old watch list that I play through every day as well. So if the stock falls underneath its 200-day or its 50-day, I remove it from my main list because I don't want to really be watching those. But then I put them in this other list so I don't forget about it, because sometimes your best ideas will come from those. And so if you look at them every day, you'll see if they start coming back. So it's just base building at this point. It's good that it held above the 2150, which was the low over there. But you can see with the market, let's see, this is what the problem is. It's not the stock, it's what's going on with the market. I mean, that is serious problems. You're underneath the 200-day, you're underneath everything. You fell through there. Let's see what the Nasdaq did. That fell apart. Let's look at Microsoft. That looks terrible. It's a Home Depot, even like McDonald's, that all of them. If a McDonald's is falling apart, let's see like a Johnson and Johnson. Yeah, they're even hidden Johnson and Johnson. So we are going to, was Dell around back then? Oh, it's not in our database, I don't think. All right, so we are going to go back to Cisco. So we're going to go out another week. Let's go into September. Okay, it's just base building. Go out another week, base building, stuck underneath the 50. That's right here, declining 50, kind of spooky place to be. Pokes above your declining 50 there, but it's not really an entry point. That's not a clean entry point. But if you wanted to take a stab at it there as it recovers through the 50, that's fine. But your stop loss is going to be, as it comes back underneath the 50. So you give it a shot there, you back out. I probably wouldn't. It depends on how much I knew the fundamentals, but I wouldn't do it in any big way because of everything that's going on. Now it's going to go out another week. And it's fallen apart. Go out another week. Now this looks, let's just remember this. Well, no, I was going to bring up the other chart, but here's what ends up happening, but the 95,702% from February, but how do you handle it? Right. So far it's an Otis Redding, Black Crows type of stock. 2 people got that. That's fine with me. So you've got hard to handle. So 22 was your earlier low here. So at this point, the only way to get into this stock is using the Livermore Shakeout +3, which Bill kind of adapted it from This Is How to Make Money in Stocks by Jesse Livermore. Probably it's debatable if this is my favorite book or Reminiscence of a Stock Operator is my favorite book. Depends on the day of the week. This is my original copy. I literally traveled everywhere with this for decades. I got it in 97. This is so good. My favorite notes, I write like a 5-year-old, never average down. Don't average down. Look, and its poor thing is falling apart, but it's special to me. Please go get this. I listen to it on audio now. It's my preferred method. So the reason why I brought that up, went on that tangent, was Bill came up with this Shakeout +3 rule, which he adapted from the way Livermore looked at things. And the concept was for stocks that were $30 to $60 that he would use $3 as your buy point. And how we would do it is saying that if there was a stock that he wanted to get into, like Cisco, and it was base building, like this was doing, and it hit a low, like this did at 22, that he would, if it went back through that 22 and surpassed it by 3 points, that would be his Shakeout +3. Now it confuses people a lot. And so that would mean, 22 +3, that's 25. So then that would put the buy point right there. Now, then he would adjust it, if it was a $15 stock, he would say it was like $1.50. If it was a $200 or $300 stock, he would adjust it a little bit. And I'm not a fan of that. I'm like more black and white, like, okay, is it Shakeout +3? So I thought a long time ago, I said, okay, it's $3 on a $30 to $60 stock. So that translates into 5 to 10%. So I'm just going to change it to 5 to 10%. So 22, let's see how that math, let's just bring out the little calculator. So if we get 22 times 1.05, so 5%, that would give us our first entry at a 5% entry at 23.10. So that would be right about there. Let me see. Right around there, give or take. And that feels a little low, to be getting in to it. So then I also do the 10%. So 22 times 1.1, 24.2. So that puts you right back over your 50. Your 50-day is at, you can see that in that little box, 2409. So 24.2 would get you right at that 50-day, and it's the Shakeout +3. So rather than using the 25, I'm going to use the 24.20 because that makes more sense to me. Now, I might even get in a little bit before that. That's if that works out, but I know it works out because, again, I kept this chart next to my monitor for years, 3 years, I think. So we're going to go out. Ooh, I went out too far. So let's just go out one day. Okay, so this is Monday. Nothing happening. Tuesday, and you can see why the 23 and change just felt a little bit low. It really doesn't give you enough evidence there. That's the day we would be buying Cisco for the first time. So, well, the first time this go around because we tried it over here. So now we're buying it there. Now, are you with me? You don't have to do it this way, but I'm going to show you why this is the right way to do Cisco. So you'd be buying it there. And again, Bill would be saying buying it there. That's not that much of a difference, but it's just whether you're OCD or not. So this day I'm adding to it big time because now you're up 9% after a shakeout plus 3. And that's what you should have. You should have this power after it. And you can also see that even though pattern rec isn't picking up, you can blame me since I designed it. It took me a decade. That was a long project. So here's your double bottom, and 27 would be your midpoint of your double bottom, and that would be your standard way of buying it. And if it goes through there, that's where you'd want to be adding to it, and that tends to happen with the shakeout plus 3. So let's go out one more day, October 19th. So, oh, wow, you get this massive gap. So if you're waiting for the double bottom, the 27, and this becomes very important, and I became obsessed with this for a while, and why this is before I was using the shakeout plus 3, because Bill took it out of this version of how to make money in stocks. It was only in the first 2. This is the 4th edition. I think in the 3rd edition, he removed it. It was only like 2 lines in there, and it would confuse everyone. And at the time, he rarely used it, and I didn't really understand it back in the 90s because I didn't start working with him, even though I was in his research department until late December, early January of 2000. So I didn't know this shakeout plus 3 when I was studying this, and I was looking at the double bottom saying, okay, this is where you'd buy it. And I'm going to show you where the problem ends up being. So 27 is your buy point, but it gaps through there. And you can't assume that you're buying it at 28. If it's a gap, you kind of either have to assume the average of the day if you're using a TWAP, which is time weighted average price entry, topic for another one of these, very important way of trading. So I just like to use the closing price because you can always do a market on close order. So it's realistic to say, okay, you're getting it on the close. So that is 28.75. The low is 28. Some people might say, oh, I'd buy it at 28. No, you wouldn't. I mean, how are you going to get the low of the day? Maybe get the high of the day. You could just average the two or take the close, 28.75, because everyone could buy that. So now let's see what happens. Ooh, wow, it's moving up exactly what you want. So now we're rocking and rolling. It looks really good. We'll go out another day. Now it's through how pattern rec is picking it up, which is the wrong way, is a cup without handle. So it's going through that entry point. All looks good. Let's see what's going on with the market. Let's see. All right, so your market came down. Here's your day one. And day one of a rally attempt, day 1, 2, 3, 4. So here would have been 1, 2, 3, 4. So fifth day follow through. Volume's not on there. Let's see if volume's on NASDAQ. Huh, that's strange. But we'll just assume, let's go back. We'll assume that volume was higher on that day. So then you would have had your follow through on the 18th. So let's go back to let's go to the 18th on here. So that's what a follow through day, very, very important concept that Bill came up with. And we can talk about that on a future one of these. If I still do them, I mean, they do take up a lot of time, but if you guys like them, I'll do them. So here's on a follow through day, the best merchandise typically is going to have the biggest moves. Up 9% really looks like it's his biggest percent gain during this run, at least it appears that way. And so everyone has it on their watch list. They're waiting for the market to turn, and then they're buying this there. So that's an important thing to go through. And let's see, we're on the 24th. It's up there. Everything is looking good. So now the problem is just, how the question you're asking yourself is, how deep in this position would you want to be? And I'm not sure what that answer is, right? So right now I would think to myself, if I was doing it right, and you have to put out of your mind that it went up, 95,000%, that you don't want to get too heavy too fast. And that's my biggest weakness, is I get too heavy too fast. And one of the last conversations I had with Bill before he retired, that when we were discussing my trading, and it was that I just have that racehorse mentality of, you just, going for it. And so I'm trying to always curb my own enthusiasm with a stock. So knowing your upper limit is 25, and this has just gone straight from the bottom, which was why we, I guess, sold it at the top before, straight from the bottom at 20 up to past 30. Um, maybe I'm going to be like 17.5% in there. I definitely want to be over 12%, over 15%. And I know my upper limit is 25, but it hasn't had any shakeouts yet. So I don't want to get too heavy. So ask yourself, where would you be? Jot it down, and then learn from it. So now it's stalling a little bit here. It's fine. It's entitled to come back in. Now let's go back there. So stalled a little bit. What I mean is you're at new highs and you have a low closing range, 25% closing range. So your expectation is for further weakness when you get one of those. And your expectation here, I would say, would for it to be to come into 30 at the maximum. And we saw that it blew past that, down 7%, well under 30, closes at 29. Let's see what the market is doing. Okay. It makes a little more sense. The market came back through its 21 day. That's problematic. It hasn't undercut our follow through day low, which is down here. But it looks like it wants to get there. So we're going to go back to Cisco and see, okay, what are we going to do? So let's say we were 17.5% invested, market's falling, it's down 7%. How much are you selling? Are you selling at all? I know myself, after stalling in a big break like this, my expectation is the next day it's going to be $28, like at least $28. So I want to get some more stock sold here to be able to withstand it coming into 28. In fact, what would be normal would be coming in, shaking out underneath this gap. That would be normal and natural. Anything more than that could be in the cards, but you want to know, like, what is your expectation? So if that's my expectation, I don't want to dislodge the shares that I bought down here or the shares here, but anything I bought up here, might have to let those go. That's the decision. And we will see how this plays out. So that was the 25th, this 26th. Okay. So that's a Friday. So now you've got the stress of going into the weekend. The market is failing like that. And your stock is off 7%. And you had whatever, maybe you had 2.5% in it. Maybe someone else had 25% in there, somewhere in between. That's still hurting, right? Because everything comes in at the same time. All right. Came into 28. And I don't honestly remember that was 28, but that's normal and natural, down 3.5%, give or take. That's what you'd like to see. If you get a bad break like the 7%, you want the next day, you don't want that to accelerate, you don't want that loss to be 8%, you want it to be less. So it's within expectations. Let's look at the S&P, see what that did. That came down further. Now your high is underneath your 21 day. That looks bad. And so the reason why we sold a bunch the day before was we were expecting this. So as my buddy Justin Nielsen always likes to say is, when you're in a position like that, you're kind of like a boxer who's tightening up his stomach, getting ready to get punched. And my son's a boxer, which as a father makes you half proud because he's such a tough dude and so strong and athletic and smart and everything. But you also don't want your son to get hurt. But if he was in the boxing ring, not professional or anything, he does it for fun, that he'd be tightening up his stomach. So that's what you're doing the day before. You're tightening up your stomach by reducing your exposure, but because you don't want to be panicking. So let's say I was at 17.5% and I brought it down to maybe 10% the day before. In a perfect world, I might not have to sell anymore on this day. But what I would be doing is selling other stocks that I own because of what the market was doing and to protect this, because this is, I would consider it an A stock, with that type of breakout and the shakeout +3 and everything. So I'm trying to protect this at all costs. I know this is a bit long, but it's free. So what the hell, man? Don't complain. You can turn it off. And like I said, it is a good sleeping aid. Oh, okay. This is beautiful. This is one of my favorite days ever. Upside reversal, shakes out underneath the 27, shakes out all the way down here. And you want to remember that if you had bought it on this day, if you didn't use the shakeout +3, so you bought it at the close there, 28.75. So let's do the math there. 28.75, and we're going to say our max loss is 7%. So we're going to multiply that times 0.93. So 26.74. Let's just call it 26.75 back in the day. So what was our low here? 26.50. So it broke through our maximum threshold if you had bought it on this day. And now some of you might say, oh, well, you wait until the close. Well, no, if you're following Bill's rules, if and I agree with these, if your stock is through your maximum loss, you need to sell it there at the market. Because if you've studied enough of these, they don't all come back like that. That thing could have come all the way down here. And now if you're saying, and then you would have been wishing that you had sold it up there. So, realistically, if you had bought it there, you would have been out of your entire position. That's why you use the shakeout +3. So now anything that I sold up here, I'm buying back plus more, because the shakeout after a solid breakout, in the bounces off your 21 day, as this one did, closes in the upper part of the range. This looks so freaking beautiful. I cannot tell you, like, print this one off. This is what they're supposed to look like. And if you didn't trade it at all, or let's say you blew out the entire thing, at the lows here earlier in the day, you blew it all out. Maybe you shorted. I wouldn't do that, but let's just say whatever, you cover that and you get really long, because now you have something to trade against. You have this low. That low should not be breached, or there's something wrong. So now let's go out to Halloween, and it bounces up. You'd want a little bit more of a bounce, frankly. But let's see what the market's doing. The market's still weak, but it did firm up, and it never didn't even trade below the low of the follow through day. It could have traded, you just don't want to close below there. So let's go back to Cisco. Oh, you know what? Let's look and see what's Microsoft doing. So Microsoft is acting weak relative to Cisco. That's, worth noting. Now we're going to go out the next day. Let's go out to first, really nice action. Oh, I call this kind of in the setup day category, where you're coming up to a resistance area, the old 30.25, and you're closing your highs. For it to be a true setup day, I would really want to be a smaller spread. But your expectation is now for it to break through there. And again, it's a Friday. Fridays are very important. Let's see what happens Monday. It's acting normally in a normal way and very powerful. So now you're gunning it, because after this day, And that's what you're looking for. You're looking for these clues, like where would you, hit it hard? And that's where you'd hit it hard and you'd be adding to it on this day and you'd be adding more to it there. And now you're saying, okay, I'm getting this up to my max position because I have some lines in the sand. It shouldn't really, if it were to come back down there, it would be a little bit weak. So you'd have to reduce some, but you've got a lot of it bought around this $28. And, really in our assumption is we still have stock that was bought down there. Let's see what happens. Okay, now it's going higher and we'll just go 1 week at a time. You could have been adding to it on this day. Let's go out a week. It's acting normally. Where would you add to it? I'd be adding to it on this day because it paused for a little bit. Now it's breaking the highs there. If I didn't have my max position, because now you're up 31% from $30, in a blink of an eye. Let's go out another week. And really at home, you should be doing day by day, I know I'm just going a little fast, or slow, depending on how you look at it. So now a little mini upside reversal. So if you still wanted to nibble, you could, because your assumption is that's going to hold. But when they're way up there like that, they don't have to hold, but they should. It will go here. Okay, it's moving up, holding it nicely, respecting the 21-day there. And okay, this is the first time it's doing anything where it's, kind of breaking character for this initial run, but they don't go up forever. But, really the day before on the 3rd, that's why Januaries are always so hard, that right there it breaks the 21-day. So if you would push, it's kind of a wake-up call, right? Like, okay, if you pushed it too far and your limit was 25, but you got carried away and you went up to 51 and a half, maybe, let's say, you need to dial that back, because this could come into the 50-day and you don't want to be over your skis there. Normal and natural would be coming into the 50-day. You always want to think about that with an extended stock. So, but you don't have to do anything. Now, from a swing trading standpoint, one of my rules that, if you guys watch the last one, I referred to my quicksand Grateful Dead rules, which are around the RS line. And that's an important concept, is something I came up with, that this is your short-term moving average. And when it breaks that, if you're swing trading this, you're reducing some of your position there. But you're waiting for it to actually go through this one to sell the balance of it. But you can also use that. That's if you're swing trading. But if this is, you've done the fundamental work and you think this is going to be this great potential to have this, be a model book stock, you're not using the daily ones, you're using the weekly. And so here is the RS line on your weekly, and this is your 8-day moving average of it, and this is your 8 week, and then this is your 21 week on there. And since I was a little bit, I don't want to throw you guys off, so here's where you find those. Go into the little wrench, go to relative strength line, and use these settings. These are my settings, and then feel free to adjust if they're too tight or too loose. I use simple on all of these. 21 for the day, 8 for the week, 10 for the month, and then the RS2 also against S&P 500, the 50-day, the 21-day, and the 24-month, or 50-day, 21 weeks, 24 months. So, and those are not set in stone. I might change some at some point, but so far my research has shown that that's kind of the sweet spot. So with this, it's holding above those, so it's not giving you a sell signal there. But the fact that it broke through this, you're tightening up your stomach and you're preparing for it to come in to that point. All stocks come into the 50 days. So let's see. Wow. That's pretty good. It didn't even come to the 50-day. Go out another week. Wow. Really wasn't expecting that. It's been a while since I studied this one. I really thought it was going to undercut that. So here, now that it made it back above its 21 day and it didn't come into the 50, that's where you could be, if you had sold any in here or reduced exposure, you could be adding those shares back there, and there, because it's, it's breaking all of that. And now you've got lines in the sand. It shouldn't come back down through there. Now, what else are you observing? Just don't pay attention to what I'm saying. Look at this and you might see a lot of things on there. I can't talk about every last little thing on there or we'd be here forever. So let's just go out another week. It's just acting so nicely. Let's toggle over to the weekly. In that held above, didn't trigger any of our quicksand Grateful Dead rules. It's looking good. Let's toggle back and let's see what the market's doing. Okay, it came back up. It had a little bit of a pullback. That's why the Cisco was correcting, but this was really your key day, an upside reversal as it was testing the lows, near the lows of your follow through day. You got back above your 21 day. And then you regain that right there. And now you're back above the 200 day, which is a big topic. Remind me and I'll do that on a future one because boy, is that important. Okay, so all is looking good. Let's start skipping ahead a week at a time. Okay, I think you get the picture here of what's going on. Let's go out a month at a time. Okay, so now this was our first on a daily 1227 or 227. This is our first time that using the daily that we got our Grateful Dead signal. For all you deadheads, happy. And what that is when the RS line goes through your longer term moving average, which on a daily we just talked about was your 50 days. So that would be if you're swing trading this, that would be where you would throw in the towel. But if you're position trading this, you're using the weekly. And that is just coming in and it's still above its short-term moving average. Now, I will say, if you are up enough on the position, let's say you're up, we've got an average cost, let's say in $30, give or take. And at one point you're up 100%. You could be up even more than that because we bought some around $24, $25 that, so you're up a lot. You can actually switch over to the monthly and use those rules. So if you don't like all this active trading that I'm walking through, you could just say, okay, I'm going to use, the 10-month and the 24-month moving averages there. Obviously, we don't have all that time, so that makes it kind of like you can't really do it on this one yet. So you would have to use the weekly, but later on that will become something that when we have enough time that we could toggle over to that. But for now, you're using the weekly ones for your defensive selling. So let's go back to the end of this month here. Now, here it did trigger those. So here is I'm going to blow this up a little bit. Your RS line came on a weekly basis, broke it here. Looks like 3-1 or 3-8. No, it looks like 3-1. Let's go there. No. Okay. So on here, you're still above your 10-week line, but your RS line broke through your short-term moving average. So that is telling you to sell some of your core position. So by core position, in our case, let's say your maximum position is 25% of your account, or let's call it 15%. So your last 10% from 15 to 25%, that's your play area of you can, trade around those shares, sell into strength, buy some on weakness or breakouts or whatever, but your core that you're trying to hold is a 15%. Now adjust these if 25% isn't your max, but for today, that's what we're saying. 15% is your core. So to keep it very, very simple, we'll just break that into 5. So when you get your quick sell signal, you sell 5 of that core. That assumes you've already sold the other stuff. So you're just down to your core position at this point. So now you brought it down to a 10% position because you had your quick signal. Now we're going to go out another week, and you can see that it actually triggered both your quicksand, which is meaning that the RS line goes lower than it was on your quick. And again, there's a separate video for this that I'll link. Probably do another version of that to have a little bit more nuance in there. And now it went through your Grateful Dead signal where it went through your longer term moving average. So this is where I would exit based on my rules. Now I know that it went way up from here, and we know from Bill's thing that's just where is that? So breaks the 10-week. So that's right in here. And so all we see him saying is add, and sell up here, but we're being just different approach. So at this point, I'm going to be out of it. That's sad. Now, if we would have been using the monthly, if we had enough history on that, we could see that it didn't even break that. So that's a debatable thing, whether you're going to toggle over to your monthly, but that's a little bit of hindsight BS, frankly. So I'm going to say I'm out. And let's look at the daily. That looks pretty weak. It pulled back in here, tried to get it back up to highs, installed, and then had a downside reversal exactly at the old high, 60.75, and that's where our old marked high was. So that's telling you that you're in trouble. It couldn't get there, and it should have just stopped at the 50-day and gone back up. But that looks pretty bad. And if you look at it on a weekly, you are now 10% underneath, 10.7% underneath your 10-week line. And our good friend Jim Ropel always likes to say, use the 10-week line as your guardrail. So this is sad, but I'm out of it and I'm looking to get back into it. So let's just go through this procedure. Now, what I like to do is wait for the RS line to be back above both moving averages. In most cases for buys, there are some exceptions, but in most cases, that RS line is still underneath those. So I'm just watching it. I'm going to wait for that to be above it before I consider buying. We're going forward a week. Okay, so it's back above both of them on this day on 4/11. So let's go back one day. So now it's saying that we can buy it, or I can buy it. That's my rule. We can buy it. But this is very sloppy. I mean, let's just be honest. I mean, this does not look good at all. Let's look and see what the market's doing to see if there's any market's doing okay. Let's look at Microsoft. No, Microsoft acted nicer. Home Depot, which was a big stock back then. Let's see about Amgen. Amgen was hanging in there nicely. So let's go back to Cisco. So that's weaker action in there, especially this day here. A big, powerful day to give it all back and then undercut that. That's a bit problematic. But this is our first, maybe by this time, we've done a ton of research and we really like it. Now, where could we buy it? So we saw in this, that Bill said to buy at 660. The Livermore rule on a $30 stock as it undercuts the low, recovers 3 points, it becomes a buy. So the stock was 26.50 at the time. So adjust for 2 splits. So he's saying to buy it here. And let's go to the weekly. So he's saying to buy it on this week here. So let's just use that. I wouldn't buy it there, but let's just say. So here was our low, the 22.75. So we're going to do the 22.75 times 1 point. Let's do the full 10%, 1.1. So $25 is where that would put us at. So we could buy it over 25. And I'm not going to buy it down there because at that point, the RS line was still under there. Now at this point, much higher, not much higher, depends on how you look at it. 27.25, but it's back at its 50-day, and it's gone above some area there. So at least it's logical. And that's what you want to do, is like just be honest with yourself. And frankly, because it's so sloppy, I'm not going to buy much. I might buy 7.5% there. And even back then, there was not much volume on that day, but it was up 7%. So it's getting a little sloppy. Now it goes back above its 50-day, up another 4.5%. Volume picks up over the prior day. So this is where I would add more. So if I bought 7.5% there, let's just say 5%. I'm going to probably make this a 10% here, and I'm looking for 29.25 to add some 30 0.38, to add, or 3/8 to add more. So let's see how that plays out. Huh, it's a little odd. Not what you have expected. Okay, that's what you would have expected. Okay, so it tested your 50-day there and moves up. And notice that volume picks up above everything over the prior couple of weeks. And you're up 7%. Always be paying attention up there. That's a big deal. Let's see what the market is doing. Wow, market's ripping. We'll go to our Microsoft, Home Depot, Amgen. Okay, those are all looking good. Much tighter than Cisco, frankly. That looks really good. So now I'm probably up to, call it a 12.5, 15% position, and really just thinking to myself, okay, is this going to handle out, which I'm hoping it does, or is it going to just rip through the 30 and 3/8 up there? We don't know. And so that's why I'm kind of tempering it, we'll call it 15%, which is still a big position. Okay. Breaks out 9%, goes through here. I'm making it, well, I know myself, I really make it a 25% position, but let's just say, because that's a little reckless, I'll make it a 20% on this day, because now it's broken back out of another base. We had maxed out our position at 25% up here. We'd sold. Now we bought back in. And we really avoided all of this mess by using those RS lines. Let's look and see what the weekly is looking like. Let's be honest, that's not a good looking base. It really isn't. It's sloppy. Make sure I don't have, let's put the best fit on just to see, like, that's stretched out. It looks so bad. But even with the standard, which is, you should always use the standard in almost all cases, there's nice action there. But if you think that's a really good base, it's because you know what ended up happening. That in isolation, that's what Bill would call that a wide and loose base. He would. But still, sometimes the fundamentals just override things. Let's go out a week. Not what you expected that week. Let's go out another week. Ooh, that looks nice on a weekly. Let's see. So pull back in more than you would have thought. And frankly, on this day, breaks the 21-day, pulled back in. I would have been reducing it. Now you could ask, probably saying, well, why is he trading so much? I'm doing this exercise because I know how I trade, and I know I'm very active, and I like massaging my positions. And frankly, Bill did too. Like, I shared an office with him for a couple of years, and he was always buying. He was and selling, and just massaging his positions. It wasn't like he just bought it once and just sat it and forgot about it. And just like this example, he didn't just buy it. He would be buying it, hundreds of times along the way. And typically they were just little trades, 100 shares here, 100 shares there, but getting that, staying fluid and flexible. So now I'm saying, okay, I'll probably reduce some here, just in case, and I'm waiting for it to break that to add to it. So it kind of broke it, and so I'd been adding to it. Now it's breaking down, so I'd have to be reducing on this day on 515. That doesn't look good. The RS line is back through here. This is how a base breakout fails. So I'm looking at that going, how much of it do I still want to hold? And I don't know. not a whole lot, because let's look at it a weekly. That's a sloppy base breakout failure. And down 7% on the day, down 7% from its pivot. I don't know that I'm gonna be holding any. Maybe I'm holding 5% of it, because I was buying it here, right? Buying it there, adding to it, adding to it, adding to it. Uh, and now I'm, probably underwater. So I'm gonna back away and let's see what ends up. Let's see what ends up happening. Go out a little bit further. It comes back. That's nice. That's a reality. So on this day here, as it was breaking that, I would have to be buying it back. But then now I'm thinking to myself, okay, I had a big position, great trade over here, got chopped up in it here, but not that bad, frankly. Um, and now it breaks back out again, and it's still kind of sloppy because this day here, the 33 and a half, where it broke out and came back in, that's kind of ruining the chart. But let's look at the weekly because you always want to look at both. That's still sloppy there, frankly. But I'm gonna have some, but just not a whole lot. Sometimes I do with 2.5% positions. Let's go out. Wait, where were we? Oh, that's what I had to do. Go out a month. Okay, so just going sideways. It's tightening. Now, this is good action. Your RS line is back above its moving averages and staying above them. And notice the distance from the high to the low. It's contracting. It's getting tighter. So now I'm thinking, okay, if it goes through there, I'm going to hit it hard. Okay, it breaks out from there. You get a pickup in volume. That's why I do miss using volume. That was, the highest volume in a while. There, the close is in gray, 50% closing range, but still it broke out from there. So now I'm hitting it and just thinking to myself, how much would I be adding to it? And frankly, I probably there, even knowing that it failed, probably 12, 12 and a half or so, probably adding to it on that day. Then as it comes back in, selling it there because I don't have this low cost basis anymore that I can let it wiggle around. Now it's back underneath the 50-day. So, you don't even have to be in it for this stuff, but let's just say, at most, and this is a rule that I came up with 2002, where if it breaks out of a short little thing and then comes back in here, to exit that position and wait for it to come back through it to buy it back unless it gives you a clear upside reversal. So you can see that unfortunately, this little picture makes it look so easy, which is motivational. But in the battlefield, it's not that easy, and that's why you want to do these exercises because it will cut down on the frustration that you'll have in the real market where you're like, oh, I studied these things and they're supposed to just go straight up. Now, of course, we could have just bought it down here, and just said, okay, we're going to just leave it alone. But if you did that with this one, you would have done it with just being honest, you would have done it with 15 other stocks that would have come down and never come back. Because if you look at a lot of stocks, most stocks aren't Cisco. So let's go out a week. Let's just go out to the end of the month. Okay, so it firmed up and you're back, your RS line is back above your moving averages here. The low is back above your 21 days. So you're getting back into it here, adding to it here, adding to it there, adding to it there, just knowing myself, because I don't want to go bar by bar for 25 years. We don't have that type of time. Let's go out a bit. So throughout here, again, upside reversal at the 50, adding, buying it back there, adding, adding, adding. And why I'm saying not selling is you don't have any material breaks. By material breaks, I'm defining that as staying above your green line, which is your 21-day exponential, which is a concept that I've really studied and came up with back in the late 90s. And it's really been popularized. I've been pounding the table on it, and I think people forget where that really came from. Um, that's okay. Uh, so now is your first real test of your 21 day, but it does it in a mild way where your 50 days coming up to it and it's closing up in the upper part of the range. So, and it's been running for a while. And you just count these weeks: 1, 2, 3, 4, 5, 6, 7 weeks. It's entitled to come in. So, really, something abnormal would be coming in there. And again, this isn't a run-of-the-mill swing trading stock. You're thinking, you've done the research, and you're trying to position trade this. So you're not really even probably even selling any there yet, because you had got chopped up in this space, and you got your position back. It's not going to stay above the 21 day the whole time, but you really kind of don't want to have to think about it while the RS line is above its moving averages. Let's see it on a weekly. It's above its moving averages up here. So that is helping you to stay with this. So let's go back out. Let's go out a month. Okay, now it breaks the 50 day. This is what you were concerned with. So let's go to the weekly on here. That's a material break, and you have to take action because your RS line is moved through it. So that's your quick, and it's debatable whether it's a quicksand, because that's a big topic, but it's at least a quick. And then on the daily, it went through your Grateful Dead one on there. But again, we weren't swinging this one. We were positioned, doing it from a position standpoint. So you've got to reduce. Now I'm still trying to hold a core position in there because it's still above that. But you see how hard this is. And that's why I wanted to do this one, because it's a frustrating, let's stop share for a second. It's a frustrating thing, seeing people studying all these in the front of the book and thinking it's that easy. And then they get out in the battlefield and they get chopped up, and they're like, wait, I did all the fundamental work. It meets all of the criteria, it breaks out, and yet I'm having a hard time. And you're going to have a hard time. And that's why we do this exercise. So you now just doing this, you could have seen like, okay, now I would have done it this way. Or, I'm learning too of just going, okay, the gut that tells me to not push it so hard so quickly is resonating with me as I'm going through, because I know that if I'm saying that my max is 25%, there are going to be times I'm really 33% or maybe even more than that. And so this is very helpful for me, that it's it's telling me the stove is hot, and this is what it's not super easy. So let's go back to it. Maybe go grab a water or coffee or something. I know I'm babbling on. A little tip: you can always watch this at 2.5 times, and then just slow it down and rewind for the parts that you need to. Okay, so now we're backing out of it. I'm down to like my token position because I'm waiting for my Grateful Dead signal to trigger. Let's see. It firms up. The RS line doesn't go underneath there. We'll go out another week. Okay. This is hard. You're at the lows of that week. You're so far underneath your 10-week line. You can see at the close there, it closes 71% closing range, but even there it was down 4.7% below your 10-week. So how do you handle that? Trying to think of the easiest way to explain that. That's a tricky long topic. So I'm going to go through this kind of slowly. So that's where it is on Friday. So here it is on there's Monday on the 7th. And so on the 7th, just go back to it there. It's still looking fine. Let's go to the weekly just shows it with the full week. So at this point, it's just underneath the 50-day, you've brought it down to a smaller position, it's 5%, and you're just going, how does how is this going to resolve itself? It looks like it might be trying to form a double bottom, which would be like this. You're always trying to picture yourself, okay, where would you really want to hit it hard? 45 and 3/4, because the cardinal sin is having a big winning stock and losing your position, but you also don't want to lose your confidence. So if this one were to keep doodling around and, before you know it, it's in the 20s, that's not going to feel good either. And let's see what the market is doing. So the market's falling apart. That's really what's doing this, that's a drag on there. So going back to the Cisco, and it's actually holding up nicely versus the market. So you don't have to take any action that day. Next day, Tuesday, still hanging in there, no action needed. This is where you got to take action. So even though it's not a Friday, it's now underneath this little base, 16% deep base, but it undercut the low of this day, which was your line in the sand, really. So that was the end of September. Let's go there. So with this upside reversal underneath your 50-day, you're 2.4% underneath your 50-day. So that's not that far. But you're saying, okay, as long as it holds above that, you're holding, like, forgetting the RS line stuff right now, just saying, okay, on that chart, that would be normal, natural for it to hold that level. And we went out here and we saw that it broke that. So you're probably, exiting. Let's go over the week. So that would have been, when it was down in over here, that RS line is coming in. That would be a really tough one to hold through, but you've got to be selling some. At least I'm going to be. Now, there's some people who are going to just say, I'm just going to wait for Friday. That is going to help you a lot. But you are going to have times where a stock breaks hard on a Monday and keeps going through all week. And then on Friday, it goes down more. And then you're thinking, God, I should have taken action on Monday or Tuesday or Wednesday or Thursday. And you didn't. And so you're kicking yourself. So I like thinking of it, even if I'm using a weekly chart for my decisions, I'm still taking some action each day throughout the week. So that's a question you have to ask yourself. Okay, so now on this day, on the 10th, it feels like it should hold that because it tried to get some support there, 59% closing range. And then on this day, it's back up above that. Now, I'm not going to be adding back to my position here because, one, your RS line is underneath both of its moving averages on a short term. Your high is underneath your 50-day. The chart doesn't really look right, but it's been holding up better than what the market is doing. So it's, legitimate. Here's the S&P, legitimately showing some short-term relative strength, not every single day, but a lot of the time. Let's look at what was Microsoft doing. I was holding in a lot better. Okay, so now I'm sitting there thinking, okay, I'm going to wait for it to get above its 21-day and its 50-day, which is here and here, before I'm going to buy any back. And I probably still have that 5% position. Let's go out on here. Okay, it's back above its 21-day. It's back at its 50-day. So if I love this stock, I might be buying some back. But, just being honest with myself, I'm not going to be buying it back yet. I'm going to wait for some more strength. And I'd rather pay up, even up here, just have a little bit more conviction. And remember, I don't remember how this played out. Okay, now your low is above your 21-day and your low is above, just slightly above your 50-day. So I would be buying some back here. So we're not really buying any the day before. Let's say I had my 5% position before. So now I'm maybe making it a 7.5%. I don't want to get carried away. Yeah, let's look and see how that weekly looked. Oh, this is at the end of the week. But even knowing that, still 7.5, 10% maybe. Go out another day. If it was a 7.5% the day before, then it's 10% on this day, adding some more. No need to add any here. And no need to add any there. So I think you're getting kind of what to look for. Now, at this point, let's look back on the weekly. Your RS line held uh, these levels there. So it was really just a quick, not even a quick sand. So frankly, with those rules, you could have held a 10% position that whole time. But let's just say we held 5 or 10, or sometimes splitting the difference of a 7.5. So and the reason why I say that, because again, remember the quick, let's go back to the 27th because I don't want to lose you here. The um the rule is the RS line versus its short-term moving average. When it crosses that, like it did on the 27th, that's your quick. If it goes below that, it's your quick sand. So your quick is selling 5%. So from 15% down to 10%. If it goes, RS line goes lower than that, you sell another 5%, bringing it, down to just owning 5. So again, 15% core position. You sell 5 on this week because of this rule. You've sold other, your position from 15 to 25, that amount for other reasons. But this is just your core using the quicksand Grateful Dead rules. So going out the next week, the important thing was, did that RS line go back underneath that low? If it does, that's a quicksand, which means you sell some more. So what I was saying before of only owning 5% really was owning 10%, because this is a hold rule. On the 11th, it dips down, but it doesn't go below that. So still at your 10%, didn't go below that. Didn't go below that. Let's go out another week. Didn't go below that. Okay, so really through this, when I was saying we were down to 5%, it really it was really a 10% using these. So that kind of changes the dynamic about what we were buying in here. You know, and if I knew how to edit, I still wouldn't edit and go back, because this is just real. This is as you go through and you're learning these things. So in practice, I would go through and say, okay, it wasn't a 5%, it was a 10%, and how would I be feeling about that? And so that's where you've done it, because it's a base breakout. So we had this little double bottom type action, double bottom with a handle, is breaking out from there. And I just know myself, after sitting underneath the 50-day with any position, I would have been scared to death, even 10%. At the lows of this day, man, that's a rough day. I mean, just think about this. I wish we could change it to 1010. Just picture what that bar looked like at the lows. You're thinking this is coming all the way into your 200-day. Don't fool yourself and thinking, oh yeah, I'm be loading up there, got some, come on, be real. You're scared. And if you're not scared, you're crazy, because you should be scared. There's a time to be, as Livermore would say, the great Livermore would say, you should, there's a time to, I'm paraphrasing, there's a time to hope and there's time to fear, and people kind of do it in reverse. When you're underneath your 50-day, you should be fearful. When you're above it, you should be hopeful. And I use that with the 21-day as well, of course. So let's go back to where we were. And I think let's go out to the end of this week. So there I would have been gunning it, probably 25%. I would be max positioning it there, because now it's all about risk management. Where do I know I'm wrong? I know I'm wrong if it comes back underneath here, because this was the low of your handle of your double bottom. It's underneath your 50-day. And if you have a base breakout failure there, you're in trouble, because then this thing could come down. At best, it base builds and forms a base on base, but worse, it could be done, or it could come underneath your 200-day down there. So this is where I'm gunning it. So this is a lot of work, but it's also risk management, and you don't want to fool yourself into thinking that you would have just bought it originally and just held the whole thing, put 200% of your account into it, and just rode the wave. Come on, be real. That this is about being intellectually honest with yourself. You're only hurting yourself if if you're not being real. So, because think during this whole time, you had a portfolio of, let's call it 7 other stocks, or in my case, maybe 20 other stocks, that those were getting chopped up too. So it's not, you're not just dealing with Cisco, you're dealing with the market, the Fed, any, news that's going on. It's a hard game. But at this point, also being honest with myself, I'm just trying to not break my rules of whatever my limit was, the 25, because I would want to be, 50% in there. I just know myself. So this is why I wouldn't want to be 50% in, because then I'd be really scared. But 25% down 5% on the day. What is your expectation? Your expectation is coming in there, shake out below the 21 day. That's what happens, normal and natural. And you're still well above your line in the sand. And remember, we talked about half of them will pull back into the pivot area. This is normal and natural, just not fun, but it's finding support around its 21 day. And that's the reason why I say that is on this day here. Let's go on the 18th. On this day, upside reversal near your 50 day. If you're shaking out the day before, you're probably adding to it there. And then this day, even though it shook out below that it was getting support there, closed back above that area, and just doodling around there. And, again, it was shaking out below there, but still closing in the upper part of the range. Let's see, does it end up failing? I don't remember. No, it's just holding in tight. Go out another week. Ooh, came back. So here, if you'd been worn out of any shares, this is where you're adding them back, because now your line in the sand has now been bumped up. So before it was over here, now it's at 48 because it had this pullback and it came and it survived that. Now it's back up here, downside reversal, expecting it to come in probably to that area. Let's see what ends up happening. Doesn't even come in that way, that much. Looking good. Wow. Now it's really taking off. If you had any more to buy, you're adding it to it there. Now it's just going. Now you don't have to do anything. You're maxed out. You can't do anything. Maxed out. It's just ripping. And remember, our line in the sand is there. Now our new line in the sand is our RS line at our on our weekly, because now that we're out of this mess here and we've got our max position. Remember, our max position was back over here. We got chopped around in here, but not that bad, frankly. And got chopped in here, but not that bad either. And we started it down here. That now we're up so much, we're forgetting the daily at this point. There's a time to kind of switch from the daily and go to the weekly, and that's when you're up so much. And that's where Bill's genius was, that he would focus on the weeklies once he was really out of the gate, and it allowed him to sit. And that's something I need to work on, is when I'm in it, I'm always looking at the dailies and the interdays, and he would look at the interdays too. He would call me up all the time, and everyone thinks he only looked at weeklies, but he'd be like, Mike, pull up the 5-minute chart on Corning. And then he'd walk through, because he was a tape reader, just like Livermore was. And reading the tape is, what interday charts are. And so, but then once he had a big enough cushion, he would just focus over on the weeklies and just let it bake. And he didn't have that pressure of, letting it come in on him. He was just, he was just hopeful that it was going to go much higher. He was not fearful. And that's what separated him from everyone else, frankly. So at this point, we are switching gears. Really it would have been over around that point, switching gears over to the weekly and using the quicksand Grateful Dead rules that I came up with, and just trying to make life easier for us. And let's just go out a month at a time. It's this green line staying above this is keeping us in. We did all that work to get our position, and now we're just using these to sit with it. Okay, so it's coming in. Let's look and see what it looks like on the daily for some context. So we've got this kind of tight flat base, 11%, but it kind of broke out there and is failing. But again, we had switched over to the weekly. Now the daily, this is for your, again, our max position was 25%. You can use the daily to sell down to 15%, but a 15% position, things like, base breakout failure, cutting through your 50-day, down 7%, yada yada, pickup in volume, all those things. But you're holding your core position and using the weekly or even the monthly. So here it is on the monthly. Now that we have enough time, and if you really think that this is something special, you can use that monthly. And again, that green line versus here. And now we finally have a Grateful Dead signal, which is way down there. So you couldn't let it fall all the way down there because then our new cost basis is in that area. So let's look at it on a weekly. We are getting a quick signal because your RS line is, let's blow that up, is through. This looks like it's touching that that line. So it's debatable, but we're going to say we're going to trim some. So now we're down to a 10% core position and see what happens. The RS line pokes back up. So we only have that, it's still the 10%. Let's go out another week. Okay, now it went lower. So now it's your quick sand rule because your RS line went back below where it first broke. So now you're down to your 5% position. But if you're using the weekly, now if you're using the monthly, you're not doing anything. So that's a big topic. But at this point, so now you're down to your 5% saying that as long as the RS line holds above this, you're going to sit with the rest. Let's look at it on a daily. It looks like a mess, but let's go out another week, holding in there. Okay, it's getting really close. Looks like it's going to break. It just found support there. Didn't go below it. Now it's popping back up. Okay, so your RS line is now back above it. You still held on to your core 5% of your position. Your RS line is back through it. So now you could be adding to it. So we're going to look at the daily for clues. And frankly, I wouldn't be buying it down here. You could go through the Shakeout +3 thing in there. Let's just do that for fun. Because this video isn't long enough, right? Okay, so $35, 35 times 1.1, 38.50. That puts you around here. Doesn't really feel that would be the soonest that you could be adding to it is back above the 21-day, but I wouldn't be hitting it too hard there because it's underneath your 50 still. So let's say we had a 5% position, we made it a 7.5. I'd be adding to it here as you got back above the 50. It's testing you there a little bit. Now adding to it more on this day. You get this big volume. That volume looks even dirty for back then, but some big volume there. And why I say it's dirty is because it really shouldn't be that much volume with that little of a price movement. So maybe there is an offering or something. But on that following day, you're adding back more because now you're saying, okay, it can hold above this level. And that's why we're doing this exercise of saying, okay, where are you going to hit it hard? So we had 5%, made it a 7.5% there, made it a 10% there. Now we're making maybe a 12.5% or so. And by doing this method, as it's sitting through the base, you don't have as much stock at risk. Even though we all know that it went up 95,000%. So now it's acting nice again. Now you've got stepping back from it. You've got a nice pattern there. Not a great pattern, but like kind of a double bottom-ish. Let's go out a week. This is getting long, isn't it? I think I need a break. Okay, so double bottom with handle. There you go. Hit that sucker hard right there. I mean, like hard, like really hard, because now we've got a line in the sand there. You had your shakeout line in the sand. I'm going 20, 20% there, maybe to 22. And then on this day, I'm maxing out because solid breakout, pickup in volume, closing at the highs up 7%. Like, what more do you want with a tight stop at 40 with some, low cost basis stock plus some cost basis stock in there? Let's see, I don't even remember if this works out here. Okay, it's acting normally. Let's just go. Yeah, nice action. Let's go to the end of the month. It's looking fine. Go to the end of the next month. Moving up. You got your max position. Okay. So you can see how frustrating it can be. You had your max position here, all right, or really here. Now let's look and see what our sell signals were. So we had missed it there because we were on the daily. So at this point on 8-7, actually it looks like 8-14 is where it did it. So on 8-14 was our quick signal. So with that, if you were up your eyeballs, you're 25% in there, and now you get the sell signal that's saying that the most you should be in is 10%. You got a lot of selling to do. Now, maybe you already did it and the stock looks fine. You're going, wow, it's holding the 10-week line, but that's why you're using the RS, on there. If I was just looking at the price action on the weekly, nothing to worry about, right? Because it's holding that, but this RS line is giving me this signal. You don't have to use it. I'm using it. So that's your quick. So now that told us that was a wake up call, saying that, okay, I'm going to bring this from my, wherever I'm in the 20s, let's call it 25% down to a max position of 10. And now it went lower. So now I'm bringing that down to just 5. Kind of sucks, right? It's frustrating. It's hard. But that's real life. You can do the hindsight BS and say, I'm just going to buy it here and just hold it. What rule could you use for that? That's pretty obvious. The 40-week, right? That works pretty well. But that works really well on a stock that goes up a ton. But you don't know when you're buying it down here that it's going to go up a 10. But those of you who want to use something slower, like a 40-week line, which is the same thing as a 200-day. Let's go over to the daily, which is your 200-day. This black line, you could just say, hey, I'm going to wait for that. I don't like all this trading around stuff. That's fine. I'm walking you through how I would do it, being intellectually honest with myself of how I would do it. You could use whatever rules you want. Maybe you want to even trade quicker than this, or maybe you don't want a pyramid. You just want to buy a 5% position at the beginning and say, as long as it doesn't go 7% below my stop, I'm not selling it, and I'm going to wait for it to break whatever. You pick a number. You can use the 40-week line, you can use the 50-day line, you can use the last low, like material low. So one thing you could say is, okay, as if you bought it here, you're waiting for the next base and saying, as long as it stays above the low of the last base, I'm going to sit with it. So when you're up here, then what are you going to do with that? You're going to let it come all the way into here before you're going to sell it? That's not a great rule. But up here, you could say, okay, I'm going to not sell it until it goes underneath this area. It's still a long way. So you want to be honest and just know the trade-offs. It's like a teeter-totter. If you've got really tight stops, you're going to have to do a lot of trading, or you're going to miss out on a lot. If you have a really loose stops, you're going to give a ton off the top. Don't fool yourself into this thing that you're going to hold it the whole way and sell it all there. I'm sorry. So because you're really doing nothing down here. I just don't think that's realistic. So up here is where you would be, selling it. And did we even get to that point yet? Let's see. This was in 1992. So that was here. And so that was over here. So we are now, looks like we're getting in that phase. So let's see how this plays out. Might be lined up. It's just looks so different to me. Let's go out a month. Okay, so went under here, quick quicksand because it went lower, but it never triggered our Grateful Dead. So at that point, you're at a 5% position, um, right there on 821. So let's go over here. So now you're down because you had your quick signal and then your RS line went lower. So that's your quicksand. Now you're sitting there going, okay, as long as that RS line holds above that level, I'm going to keep that last core position to try to have that toe hold in there. Let's go out a week. Um, Even though it goes lower, if you're just looking at the price, that's pretty scary. Let's look at it on a daily chart. It's some scary action at the lows on this day on 824. It's really spooky stuff. But you have those other rules you're using and just saying, okay, I'm going to wait for that Grateful Dead signal. Let's go out to the weekly, go out another week. Now it comes back. Your RS line is back above your moving averages. You've recovered. You have a new line in the sand to trade against. So let's go back to the daily and see, are there signals to get back in? Like I said, I don't like buying under the 50. So I'm going to be buying it back here on the 2nd, my parents' anniversary. So what is it now? 50, should know this. 58 years, 59 years. Best parents around, that's for sure. I'm blessed. So on this day here, I'm going to be adding back, and I'm probably going to be adding back in a big way because I love this stock. I was shaken out. I realized that it's I get it's it's not an easy stock. It's a Otis Redding stock, and so I need to be active with it. So I had my 5% position um, through this whole thing, and I had this as a line in the sand. Now, kind of another line in the sand. So I'm going to be adding here, probably making it a 10% position on that day. Let's go out a week. On this day, probably making a 12.5 to 15% position because now I've got the 50-day to trade against. And this is a new line in the sand for some of it. And obviously your ultimate line in the sand there. So you can kind of press it harder. Maybe it's 17.5% position. Building a little handle. And let's go out another week. Okay. So this was choppy in here. So let's go through this. I know myself on this day here, I'm going to be reducing some because I would have gotten carried away with myself up here. Just know it. I know myself. I'm going to have been carried away. So I'm going to have to reduce it as it's coming back in. But I'm trying to recognizing the character of the stock, knowing that it likes to go up, but it also wiggles and wobbles a lot. And you can just, again, we're going to go back to the Microsoft example. Microsoft isn't trading as well. Let's do Home Depot. Well, even Home Depot is having a hard time. So an Amgen, ooh, that's really running in trouble. Let's see what the market was doing. So that's why the market's falling apart. No wonder why Cisco's having a hard time. So again, it's the context of everything. This is not an easy, I mean, and look at how hard this market was. I mean, it wasn't a trending market. There wasn't a power trend there. This is Chop City. So you just again got to be realistic. So within here, down there, I'm selling stock, but now I'm going to go over to my weekly and see what those rules told me. Those rules are saying I don't have to sell any of that. So again, that's my core position. Core position is 15%. So that's why I use these rules. So all these other things that I would be selling, selling down here, selling here, those are my from 15 to 25%, but my core position is my bottom 15%. My bottom 15%, I don't have to sell because my sell signal that I'm using is not triggering it because this RS line is still holding up. Let's see if it continues to hold up. I don't really know. Okay, now it goes higher. Let's look at the daily. Okay, so it recovered from there. A little bit of a wedge here, which I'm not a fan of. Topic for another day, but just kind of moving up without shaking out below recent lows, but it's going back above those highs. So now I'm building that back up. So I'd kept 15% during all of this. Now I'm probably putting it back up to like a 20% position. But I'm licking my wounds because this has been hard, really hard. Let's go and look what the market's doing. So the market stabilized here. For fun, you can go back and really study the market in great detail during that time, but that's a lot of we'll do it though. We'll do it another time. So now we go out another week. It's looking good, but not super powerful. Looking good, a little bit more power now. You can see that RS line is up there. So this is that power of that RS line on the weekly. It kept you from selling any of your core position during this. And let's go over to the monthly. What's the monthly looking like? Well, if you had toggled over to the monthly at some point during here, you don't have to do anything. So if you're kind of a slow trader, you've done nothing with that monthly. So now let's go out. I gotta speed up because man, I gotta go to lunch. My better half is like, I told her I'd be like 20 minutes. That's what I had planned on. So let's just keep going. It's ripping. This is what all the work is for. Just moving up 3 weeks tight. Looks good. Look, your signals aren't. Oh, I know myself. I'm saying I'm going to break my rules of how deep in to be. Let's see if that works out. But no, we'll be good and only do 25%. Damn. Wish I broke my rules. Oh, I should have broken my rules. Oh, look at that. Oh, it's just moving, moving. Finally. Okay. And look, test your 10-week line, but your RS line doesn't budge there. Let's look at it on a daily, as ugly as this looks, but on the weekly, it's not doing anything there. So you're holding your core position, not doing anything with it. That's why I developed those rules. Because I've gone through this and it came out of sessions like this where I was doing it going, I've got to use something on the weekly that I can believe in to hold me in these things. It's moving. It's moving. Oh, you had a little signal there. We missed that. Okay. So on this one, you had a quick signal because the RS line moved through there, breakout failure, late stage breakout failure, but not in a big way. Just came down your 10-week line, but still, because of that rule, you're reducing it down. So the most you can have at this point is a 10% position. That sucks because we know it goes a lot higher, but it is what it is. Rules are rules. Oh, that helped us, right? Because if we didn't sell it down that day, that week before, you would have been panic. I would have been panicking down here and blowing out the whole damn thing. But now that I had those rules and I locked in a bunch of those, because remember, we were like, where were we? Is it max there or is max? It was out of here. Yeah. So we were max in this whole way, and now we're locking it in up near, not down here, but up here. And now we had a 10% position. Didn't go lower on this week. So still holding at 10. Okay. Now we've got our quicksand because it went lower than our original. Let's blow this up some more. See, that was our first sell signal there. Now it went lower. So we're selling more. So now we're just down to our 5%. Let's see what happens. Curious. Okay. Oh, chart's not acting good, but RS line is still holding up. Okay. Got to throw in the towel if we're using the weekly, because now we've got our Grateful Dead signal where the RS line is back through here. Now, for you monthly folks, it's just starting to roll over. So you can decide whether to hold it or not. I'm still using weeklies for the most part. But the monthlies, if I could get my temperament for a monthly, I would like that. Maybe I'm 53 now. Maybe when I'm in my 60s, I will, if I make it long, hopefully, that I will convert over to using monthlies just so I can slow down in life. And hopefully by that time I'll have grandkids, and I would love that. My kids watched. My kids are too busy to watch this stuff. Oh, look at that. Comes right back. Okay, so now we're hitting it hard because our RS line is back through there. We had a massive shakeout, shook us out. And so this double bottom base on base, and we're buying it there. Let's do the shakeout plus 3. 40.5 times 1.1, so 44, 55, 44. Yeah, so on this day, yeah, that's where I would have wanted to buy it anyway. So your shakeout plus 3, you're buying it here. So again, we were completely out of it, unless we use the monthly. Using the weekly, we're completely out of it. And we're buying it back. You got to be willing to buy it back. So I'm buying it back 7.5, 10% position easy on that day, because now I have max line in the sand is over here, but really over there would be where I'd be getting out. So 10%, 12%. Then on this day, let's call it a 10% there, make it a 12%. And then on this day, 15%, easy. Look at that volume on the breakout up 7%. Let's go out just one more day, see what it does. Goes up some more. I think this is around where Bill was saying to sell it. Let's see. Let's bring that back over. Yeah, this is where he's saying to sell it. That's him. And he marked it up that way, so it must be right. But let's see. I'm just being honest. So we know that he's saying it to, well, let's look at apples. He was saying to sell it here, right? Because here was your base. Stock has splits and goes up straight up from the bottom. I'm looking at it as shakeout plus 3. Looks good to me, but it probably, again, I haven't looked at this one in years. It probably falls apart. This is why you have to be intellectually honest with yourself and just know, I'm maxing out, if I only have a 17% position there, I'm tempering myself. And then on this day, because you had this nice little shakeout here, again, I'm assuming this blows apart because of where he marked it, but I'm adding to it on that day because little shellfish type of, not really a full shelf, but just a little like mini handle there. Let's see what ends up happening. Is anyone even watching? It's fine. I'm just doing it for myself. I kept going. Thought it was going to blow apart. Let's see. It's got to blow apart at some point. Let's go on another week. Okay. It's probably gonna, another base. All right. So it's forming another base in here. Let's go out. Are you really watching? I looked at the stats on my last video I did, and only 3% of the people who watched it were in there for more than 20 minutes. It was like an 80-minute video. So I guess I am doing this for myself. That's fine. So let's just assume that you were in this whole time. You should. Let's go over the weekly. RS line held above it. And looks good to me. Let's go out. Okay, that's a little odd. With that breakout, it shouldn't have come in that much on that day. That's just not normal after this day, because this day here, July 1st, that's normal. That's normal. That's normal. Let's just go one day at a time. Normal, abnormal. You see that? Undercutting this low, that's abnormal. So it's a base on base, and it's starting to run into some trouble. So this is where I was, remember my max, if I'm at 25%, I'm looking at this and going, okay, I'm using these rules, the RS line, for my last 15%, but there I'm starting to back away. I'm going to be nimble, and I'm going to maybe I bring this down to a 15% position here, because I'll just say, okay, If it goes back through there, I'll just buy it back. See what happens. Well, it's firming up. Looks like we're going to buy it back. Oh, setup day. Okay, buying a little back. I don't like how that's a little weak. Huh. I guess I'm buying it back, but honestly, it's not going up. Notice how it's only up like 1.5%, but over here was, going up 4% there, 7% there. We saw a lot of sevens and 9%. And this is weak action. It's kind of wedgy. You know what? So if I did buy any going through here, I'm backing away from that, but I'm keeping my 15% because my other rules, but oh shit. Sorry. If I knew how to edit, I would edit. I was not expecting that. Wow, let's go back. So here, that wedge is what I was talking about before, is when you wedge, each low typically holds above the low from the day before. And a lot of people, myself included, use a lot of rules of, kind of a trailing stop for part of your position, where as long as it holds above the low of your prior day or the day before that or the day before that, you're holding it. And so if you're never shaking out below there, you get in these positions where you can have these air pockets, which I would call that an air pocket, where everyone has their stops there. And so, now you're down 7% on a big pickup in volume. So I'm like, fuck, sorry, but that's bad. Like, this is a change of character. That does not look right. Let's look and see what the wow, that looks really bad. So I'm out of any of my non-core position. Now I'm going to look at the weekly for the quicksand stuff to see, okay, so we got our quick and our quicksand. So now we're just down to a 5% position, and I'm scared to death. Like, I'm not even in this. And you got to put yourself in that position that you're in it. That's why I'm reacting this way, because I really get in it. Like, my money is at risk. And I've seen so many of these that, let's see what the market looks like. This is, markets looked worse, frankly. Let's see if Microsoft. Oh, Microsoft's running into trouble. Amgen. Oh, that's been a dog for a while. Home Depot. Wish we could do a lot of the other ones like the Dells and stuff, but they're not in the database. All right, we'll go back to Cisco. That looks bad. Let's look at the weekly. Okay, so we're just down to 5, and we're waiting to see if this quicksand. Oh, that held up. That's surprising. But still, it's a weak. Like, let's do this 50% retracement. So 50% retracement from here to here. So let's just do this. 57 is the high, and the low is 47 quarter. So let's do this. 57 plus, what did we say? 47 and a quarter. 47 and a quarter divided by 2. 52 0.125. So where is that? 52. Okay, so it's just, this is your 50% of that. And the reason why I'm doing that calculation is when you fall like that, you would really want to get back up in the upper half. So above the 52 and a quarter in a material way to say that you're out of the woods. But right now, this is just, a weak bounce. And I don't like that action. That chart looks really broken. And that doesn't look any better. Can't hold, it's coming down. What type of base is that? It's not anything. It needs time. Let's see what the weekly looks like. Okay. Let's go out a week. I'm shocked. I don't like this. But let's look at the market. Market's doing nothing wrong. Microsoft. Okay. So I don't really know this pattern. The RS line is back above its moving averages. RS line looks fine there. We know it goes up 95 1000%, but we're not supposed to use that with our analysis. I just don't know this pattern, but with that RS line being so strong, I'm probably adding some back, but not in a big way. I'm probably going to miss out. But so we kept our 5%. Maybe I'm putting this up to a 7.5%, maybe 10%. I don't know. So on this day, now that it firms up even more, but look, back then, volume mattered, and well, volume matters, but it was clean, and you're getting kind of weak rebound after selling on some high volume here. So I'm going to be buying more. I'll probably have it up to a 12% position, but not excited about it. And then I'm keeping this as my low. But still, it's 12 and a half, but let's see the end of the week, what it looks like. Okay. Um, I'm definitely out of anything that I bought back, and did not want to buy those back, but I was just scared not to buy it back, really. And so I think what I need to do is write rules to myself. When I can't identify it, don't just force myself to buy it back in, because it was really that was a struggle to buy that, and that just does not look right. Gapping down after a, a breakout out of nothing. And Bill would always say, if you can't identify it, you don't buy it. I really couldn't identify it. Now this looks like a sloppy base. RS line has come back through here. So it's capping us at a 10% position anyways. But that would be, just let's go through that. That core position thing of holding the 15%, that's when you've got a decent gain on those shares. So you're not forced to hold that full 10% because you don't have a decent gain on that stuff, but you are forced to hold that 5% because that 5% was stock that we had bought, down in here or there, maybe it was over here still. So oh no, I guess not, because we've completely blown it out over there, I guess. God, already forgot that. So, but you're still holding your 5% as long as you're up on it until that RS line goes through there, but you don't have to hold any more than that. So at most, I'm in with a 5% in there. Let's go out a week. And that just does not look good. Let's go out another week. Okay, that looks bad. Let's see. Okay, it's Grateful Dead signal is almost there. I'm just waiting for my better half to knock on the door and say, when are we going to eat? Okay, there we go. So here it finally crosses through there, actually the week before that. So on the 27th, that's when you were throwing in your towel. And if you were using that rule that I said before that some people could use, let's do a best fit on here. Where let's say you bought it originally here and you said, I'm going to hold it until it breaks the 40-week line, which is this same thing as a 200-day. Look, let's go out another week. That's when you would have to sell it. So if you're in that camp, this is the perfect stock for you. And I'll tell you, all these classic models, just holding it, not doing all this work that I'm doing, that's going to work out for you better, right? Of just buying it there, and not selling it until over here. But is that realistic? How many stocks do you buy end up being Cisco in the 90s? Not a whole lot. And so most of those, you're going to have other rules before it breaks, the 40-week line, because you're not going to have enough of a profit in there. But you could legitimately say, once you've doubled, when you're from there to there, or thereabouts, that you could swap over to this 40-week line. I'm just not wired that way. I'll never be able to do that, even when I'm retired. It's just too slow for me because I've just seen too many charts roll over. But we're out of it at this point, and I think that was a good exercise. Let's just go to the monthly, and let's just wait and see if we're doing that. See what month triggers that sell signal. We'll go a month at a time. Again, we're waiting for this RS line to go through here. Now, obviously, on the weekly, we would have been buying some back, but maybe that's a video for another time. But the bulk of it was nailed down, and we did really well. I mean, if you go through and do the math on there, that was good. So you're buying it back in a big way, you know, um, because of how powerful it's. Let's go on the weekly. You know, it's just kind of begrudgingly going up there. Oh, that's because I got the stupid best fit on. That's what was throwing me. Oh, okay, that looks so much better. The best fit stretches it out to fit on the whole chart, and I hated that feature, and so does Bill hated it, and so do I. But it's not super power. It's a different type of animal at this point because that was not a good looking base. Let's see what the market was doing. We're in that base. That was sloppy. Um, so you're buying it back. Let's just for fun, let's take this out to let's just take it out a few months. Okay. Okay, we're finally gonna get our Grateful Dead signal here. Okay. So even on a monthly, I'm gonna do the best fit thing. If you had toggled over to your monthly from back over here, and we talked about the reasons why that would have been tricky, that at this point you're selling the whole thing. So you can see that using a monthly keeps you from having to do a lot of trades, but you're going to give a lot back off the top. So instead of selling it in there where we were doing the bulk of it, and then buying some back, you're selling it all here, which would have been the same as selling it on this side. But, that's a year from, this is December of 92 and this is June of 94. That's a long time. And you're pretty much selling it at the same levels, which is why I don't like to use this. But let's go out, goes lower, goes lower. Well, we know it comes back because okay, so it's coming back. Let me turn this best fit off. Comes back. Let's just go out another year because I'm hungry. Okay. So maybe next time we'll study this. We'll study another stock, but you guys should do the rest of this and go back to the weekly, see where you'd want to buy it. Frankly, in this whole mess, and I know Bill would not be in this stock down in here, in any way, shape, or form. And look at those breaks in there. That's terrible. But over here, this is your first real base. So in March of 95, let's just go there on the let's go into March on the daily. So you got this nice little cup breakout. Let's go out to the end of the next month. So that's a little bit excessively weak there, but still, if you were shaken out, you can buy it back there. Let's go out another month. And it starts moving again. So it starts getting its character back. Let's go out to the weekly. I'm going to skip to the end of the year, end of 95. So that's where we were really buying it back in any real way. Because remember, we were really selling it over here and we just got into it a little bit over there and then got pushed back out of it. I got to make these shorter. I'm sorry, guys. I really am. Did not intend for it to be this long. If you're with me, thank you, because there's a lot of time. So you can see how this was not a good trader during this time. And same thing with like Walmart, like McDonald's. Let's do the Home Depot, Amgen. Oh wait, we've got this. No, just Microsoft. Microsoft was trading better, but it really wasn't as easy as people, think. There were things like Ascend and U.S. Surgical and a bunch of other stocks that aren't in the database anymore that had really powerful moves. But I would go through and study these, be honest with yourself of how you would have traded it. These are really tricky when you get just base on base on base. Very hard. Let's go out to end of 98. And then in here, again, the quick quicksand, Grateful Dead would have gotten you out over here. Oops. Oops. No. For that, right? Like there. So before all this mess. And that's the benefit of using that rule is it really keeps you out of any significant trouble, and then you're not buying it back until that RS line is back above those moving averages, which are over here. So you're sitting out this entire time using that method that I developed. And then let's go out to, and again, I developed it just by doing lots of these things and just going, I'm frustrated. I've got to figure out a way to get out of it. So now we're out one more year. You could see that triggered in there. This was a nasty bear market. Let's go to October 9th of that year. Okay, let's look at the NASDAQ. It was a 33% decline. And I remember trading that. That was boy, that was interesting. Doesn't look like it, but this was a really, really bad bear market, much worse than it looks like on the chart. And I'll tell you, Bill, let's go over here. This was your follow through down over there. Let's see, day 1, 2, 3, 4. Oh, actually 5. There was your follow through on the 14th. Let's go to the 14th, and he was buying AOL and Schwab around there. So AOL is not in the database anymore, but SCHW now, right? It used to be SCH. So here was your cup with handle, and he was buying it heavy there on the 9th. If you remind me, maybe we go through this one next time, or one of the times. October 9th of 98, certainly one worth studying, and he just loaded up in those two stocks and then ended up pretty much top ticking both of them. So let's go back to the Cisco 98. So look how ugly that looks. That's because the whole market was looking that way, but you would have been having to sell the whole thing on October 2nd, which was there. So before it really got too bad, let's go out to the end of that month. I mean, look how much worse, if you didn't sell it on October 2nd, then you would have been puking out there at 40. Because you should be, because that could have gotten a lot worse. There it is, out another month. Let's go out to the end of that time frame. Wow, what a special time. And let's go out to the end of 99. So this is where we're talking about before, having to be kicked out here on October 2nd. And by this time you would have been buying it back, in over here, you have the follow through day, the market was super powerful, and you could have been, buying it in over here and adding to it heavy. And it's not triggering your Grateful Dead signal. Looking at the daily chart, it would have been very tricky. Let's go out to March. Boy, I remember that like it was yesterday. So much to talk about. We don't have the time. Let's go out to, okay, so we know that the market top, so right 414, that's where we get our final sell signal. So you would add your Grateful Dead on this one, your quicksand, and Grateful Dead. So you would have been out there. Let's look at what the NASDAQ did at that point. And man, that's really what it was like. Man, one day I'll talk about the conversation I had with Bill over the weekend. Is it that weekend? Yeah, I think it was this weekend, because I would call him on Sundays, and I told him, I had been studying the 1929 crash a lot. No one had been talking about it at the time. Now everyone talks about it. But I was also studying the Nikkei, which had topped, what was it, like 89 or 90? Used to have that memorized. But so I was studying those two because those were kind of the bubble tops at the time. And I said, Bill, I really think this is very reminiscent of 1929. He's like, oh, Mike. He whispers, he's like, don't you say that to anyone. You might spook the market. I was like a 20-something-year-old kid. What was I? I don't know. I'm 53 now, so whatever I was back then, and late 20s. And who's going to listen to me? Some little PM at O'Neill, but yeah, that's what it was like. And we could talk about the the 29 to 32 precedent that I came up with at another one of these. But I hope you got something out. Oh, let's look at that Schwab. Here was the Schwab that Bill bought down in over here in October of 98. And he sold that whole thing up here in 99, in April of 99 into that climax. And then moved it into other stuff. And during this time, he was heavy into Qualcomm. And let's put that best fit on so you can see that one. So, he was buying it down in here and ultimately, selling it up in this range. He was trading around a lot during that. And you got to do the math on these that, he bought it, started buying it there, sold the rest of it, up in this area. But he was up, the best guys on the team were up 450 or 500. I think there might have been one guy who was up 500% that year, but a lot of them were trading Qualcomm, including Bill. And Qualcomm, I think you can do the math. I think it was up over 2000%, and he would do like full margin, right? And they were up 400, 500%. So that tells you that, if you were 200% long a stock that was up 2000%, you should have been up, a lot, right? Thousands and thousands of percent. But that's if you're gunning it the whole way. But of course, he's using risk management. Now, not these rules that I'm using, but other risk management tools to massage his position along the way. And that's the other reason why, and I'm going to stop the share here. Let's see. Oh, before we do, I'll just bring this up one last time. Again, this was a Cisco where he was marking it, and you can see the difference, the contrast. And I want to be very crystal clear. I'm not saying anything negative about the way he marked them up, because he did this for himself too, his own personal books. He would mark them up this way. And I was blessed to get to study those on a daily basis. And he would always mark them up like this, which I call hindsight, but he looked at it as a study of like, where are you going to, he wanted to perfectly study how to do things perfectly, using the hindsight. And I just doesn't mesh with me. I like doing it in kind of how we went through, and you just see like all the warts, it's not perfect, but it's realistic. And I'll bring in this comparison chart again. Here was Cisco starting off at the beginning when it went public up to the top where we were just talking in 2000. But let's go to today's date. Let's go out to 25 and see that even though it's up 77,000% versus 1,700 for the S&P, it topped up there and it never came back this whole time. So anyone who is going to say they're just going to buy and hold it, well, that means you're sitting through it down here in October of 02 as well. And that's going to be, let's just change this to 31 to 02. And look at, that's a long way down. And in fact, let's pull up Cisco, which is probably a very important thing if you've never done it. Let's go out to the end of okay, and turn off. So this is what it looked like on a monthly at that point, came all the way down here. And so let's look at it on a weekly. You can't even see the chart on there. Let's unzoom that, from here to here. That's those people are just going to, say just buy and hold. Well, that's fine. You buy and hold and it comes all the way in. And there's so many stocks that went down to zero. So you don't want to just buy and hold. You want to have some sort of rule, whatever rule that is. So let me stop share because dang, I'm hungry. Should have eaten before this. So look, I hope this was helpful. It's way longer than I thought it was going to be. 20 minutes turned into, I don't know, 2 hours, whatever it was, 3 hours. Don't even know if anyone's going to watch this, if it's too big to even upload. So I'm going to end it here. And look, if you have anything negative to say, as I said before, keep it to yourself. I don't want to hear it. I'll block you. I don't need any negative feedback. It's not a good thing. I don't give out negative feedback. I don't want negative feedback. If you have nothing nice to say, so long. If you dug this, then do me a favor. What I'd like you to do is just reimburse me by being nice to a stranger. That's all I ask. Just do something kind for someone who's not expecting it, and we will call ourselves even, because this is something people charge for a lot, and just want to help others. So take care. Peace.